Hi fam, welcome to Electron FX. I actually made this video, but I think something was wrong with the audio, and I had to delete the previous one to remake this one, right? Um, because of the sensitivity of this topic, right? You have to get the complete flow. So I have to make this video all over again. Right. Welcome to Market Structure Remastered Part 2. If you have not watched the first part, please do well to go and watch it. In the channel playlist, you'll find the market structure, the master part 1, and there I talked about the different kinds of markets. I define market structure, I define the different kinds of trends, how to identify what the market is doing. Is it uptrending? Is it downtrending? Is it consolidating or ranging? Is it choppy? And all of that. So that's what we did in the first video. So in the second video, in this video, we'll be talking about the second part of market structure, right? And here we'll be talking about how to analyze the market and basically how to make entries based on our understanding of market structure, right? Um, um, Before I go into the video, I would like you to just use a moment to join our Telegram community, right? To see our analysis. The link will be posted in the description. So join our Telegram. So you just have to join our Telegram community to get more information from us, right? To be notified what is going on, to see our analysis, right? So join our Telegram community with the link right in the description. So just take a minute to do this. To join our Telegram community with the link in the description. So so you get our trade setups, our signals, our analysis, and what we are doing, right? So just do well to join that. All right. In the previous video, I made mention that in an uptrend, the most important part of an uptrend is the higher low, and the most important part of a downtrend is the lower high, because that is where the break of structure happens. I also explained that in a ranging market, the break of structure happens when the market clearly closes above the upper range or the lower range. And I say that for a choppy market, you have to avoid it at all costs because there's no structural point or base of reference for you to study it. So now, this second part of market structure is the part we're talking about now. And this part is basically how to make entries. So the first thing you want to do when you open your charts is to check the higher time frame bias, right? So this is the first thing about this market structure, right? So you want to be trading in line with the higher time frame. Why? Because the higher time frame controls what? The lower time frame. So you want to know the higher time frame bias. Why is it important to know the higher time frame bias? Is because the higher time frame controls the smaller time frame, right? So you want to know the higher time frame bias of the market. Is it a bullish market? Is it a bearish market? And all of that. Please, if you have not watched my video on the fractal nature of price, please go do well to watch the video on the fractal nature of price. I explain how the market actually moves in multiple structures. That means in a one chart, you can see the 5 minutes being bullish, the 15 minutes being bearish, the 1 hour being bullish, the 2 hour being bearish, the daily being bullish, even the weekly being bearish. So this is the concept of multiple time frame analysis, or what we call the fractal nature of price. So the first thing you want to know the higher time frame bias. Is you can make the 24-hour your bigger time frame. It depends on the time frame which you trade, right? For those people that like catching the big pips, like catching the big moves, it's preferable to use your 24-hour to know the higher time frame bias, right? Use your 24-hour, your 8-hour, or your 4-hour to know your higher time frame bias. You're not looking at anything below 4 hours. Anything below 4 hours is maybe for scalping or whatever. But to be safe, you want to check the 24-hour, the weekly, the monthly. But 24 hours should be your reference for the higher time frame bias. 24-hour and the weekly, right? So you want to know what the higher time frame is doing. Right. Now, let me illustrate something. Let's assume that in the 24-hour, we are having an uptrend. Maybe the market is doing this, is trending upwards. The market trending upwards on the 24-hour time frame. So the market is trending upwards, right? So this is the 24-hour time frame, right? So this is the 24-hour time frame, right? This is the market trending upwards on 24 hours time frame. This is the daily time frame, right? Believe me that from this point here, this point right here, right? Let me highlight that point. From this higher high, right here, down to this higher low. Let's highlight that. To this higher low, the market must have broken structure on the smaller time frame, right? Let's zoom this in a bit so I can see it clearly. So the market is making a series of higher highs and higher lows on the daily time frame, but between these points down to this point, if you check your 1 hour, your 4 hour, your 15 minutes, this place will look like a downtrend, right? You see the market break structure, you see something like this at this point here. You see the market do something like this. Where's my parabola to? The polyline. So obviously at this point here, you find the market do something like this. High, go like this to break structure to the downside, and then you see a series of lower highs. To do this, you do keep doing forming lower highs and lower lows until it gets down to this point, right? Before it will break structure again to the upside and then continue rallying up. So why all this move? So if you are trying to, because maybe you saw lower high, let me just leave that for now. So if maybe you drew your trend line from this point down here, right? Let's change the color of that, size will be different. Let's make that red, right? Yes, let's make it red. So it doesn't look the same. So imagine you drew a trend line from this point to this point, and then you saw the markets coming up again, and you are thinking, okay, it's going to sell. Believe me, you would have been stopped out to break structure, come and give your retest, and then rally up. Why? Because the smaller time frame was designed to conform to the bigger time frame. So from this point down to here, the market broke structure on the 1 hour time frame, giving us a bearish setup by breaking it higher low and then giving us a series of lower highs, lower lows. And then when it got to this point here, we saw a break of structure to the upside. Why? Because this is the daily. The daily controls the smaller time frame. So all this bearish move you saw on the 1 hour from this point to this point was just the daily trying to form what is higher low. That was all this move was about. The daily trying to form its higher low. So this is how you should trade. You should know that different time frames have their different structure, and you want to know the bias of the higher time frame. So all this move from year to year was just the daily going down to form its higher low before rallying up to form its higher high. So if you only trade 1 hour, you would have been stopped out on this trade by trying to sell it here because you saw a trend line and it was broken. Why? You wonder what happened. It was simply the daily structure being maintained. So that's why it's not advisable to trade only 1 hour, because some people, anytime they come to their charts, they're only looking for 1 hour time frame. Some looking for only 15 minutes. No, you won't be profitable that way. You want to know what the bigger time frame is doing. So that's the first thing about this video. Figure out what the bigger time frame is doing so that you can plan your trades according to that. So in this kind of market, you should be looking to buy here. So maybe you saw something like an order block or a Fibonacci level. Let's draw a Fibonacci tool. Maybe from here to here, you saw something like a Fibonacci level there. Or maybe you saw it's 8.6 at that point, and maybe there was some kind of order block or whatever at that point. So it was giving you this telltale signal that, okay, it's going to buy from that point. And then maybe you saw a daily pin bar, a daily engulfing candle. These were signals signaling you that, okay, this market has finished forming its higher low. It's maybe going to form or a higher high. So this is how swing traders trade. You try to know what the bigger time frame. So even if you're not a swing trader, you're a day trader, or that I adjure you to trade in line with the higher time frame, because this is what actually controls the market. You don't want to be trying to sell a buying market on the daily. So always use your daily to try to figure out what the market is doing, right? Once I want to let you know is that though you may wait a long time for all of this, right? But it's worth it. It's better to wait and not lose money than to be in a hurry and lose money. Do you know that a money that is in your account is of gain than losing it? You know, a dollar increases with time and all of that. It's better for your money to remain in your account without you trading, and it's just there, than for you to go and be trading all the time and lose it. So it's better to wait for daily structure to form. Let it get to the higher low, then you can have a buying. You can buy when it forms a higher low, you buy again, you keep buying, and your target should be this point. So now we have known the higher time frame buyers, so you can simply start buying from this point. Sorry, you can simply start buying from this point. This is a long position, so you can simply start buying from there. Even if you want to be using intraday method, right, you can just be buying from this point. Yeah, your target should be this last high, right? So that's to be safe. You're targeting the last higher high, so that market does not give a double top and reverse against you. So on the 1 hour now, since you have known the daily time frame, you can now begin to buy. When you see the market form a higher low, you buy, right? So I'm just trying to explain this. So now on the 1 hour, you see this, you buy, you see an up move, another retracement, you buy again, you see an up, you see another retracement, you buy again. So now, even if you don't want to hold the trade from the bottom here, right, you can simply be buying at this point, at the higher low, at the higher low, at the higher low. Just keep buying and buying up till the market, until the market get to this point you're looking at on the daily time frame. So that is it about higher time frame buyers. You want to plan your trades according to the higher time frame, right? So this is it. Always know the structure of the market on the bigger time frame, and then wait for the market to get there, give you your lower time frame break of structure, and then you trade in line with the higher time frame buyers. I hope you understand that. So that is the first part of the remastered market structure. Now, the second thing you should know about the market structure, the master part 2, that is the second thing I want to talk about, which I think this will be the final thing. Right, I don't want to make this video so long because it's actually a concept that you should understand. I want to go to real life examples. So you now look for what? Confluences. So whenever you want to take a trade, you should always look for confluences. All right. What's a confluence? Confluences are simply more than one reasons to take a trade. Right? A confluence is just simply more than one reason to take a trade. There are several reasons why you should take a trade. It's not just trading because, okay, maybe the market came to 8.6 and you buy only for that reason. No, you have to get at least 2, 3, 4, 5 reasons before taking a trade. And one thing I want to say about higher time frame buyers, I forgot to say this. Always make sure you are trading with at least 3 time frames. That means whenever you take your trade, you must analyze your trade from 3 time frames. Meaning that if you want to take a buy, your buy should conform with the daily, the 4 hour and the 1 hour, or the 4 hour, 2 hour, and 1 hour. That means 3 time frames should give you that telltale signal to buy or to sell. It's not when you're seeing a buy only on 15 minutes. What about the 1 hour? What about the 15 minutes? What about the 30 minutes? So you should have at least 3 time frames that support your decisions. At least 3 time frames. So be that at least 3 time frames must support the decision to buy or to sell. Now, back to confluences. So what are the kind of confluences you should be looking for when you want to take a trade? What are the kind of confluences? Number 1 confluence you should be looking out for. You should be looking for order blocks, right? You should be looking for order blocks. What are order blocks? They're the last candle before the reversal. That means the last bullish candle before the sell move that broke structure, or the last sell candle before the buy move that broke structure, right? So you look out for order blocks. Those are the first confluence you should be looking out for when you're taking a trade. You should be looking out for support and resistance zones. Support, resistance. So you should look out for support and resistance zones. I know many people have issues with this, but it's still part of it. You should look out for support and resistance zones. So that's another confluence you should be looking out for, right? You should be looking out for your support or your resistance. And the next thing that should give you confluence to your trading should be what we call supply and demand. You know, there's a difference between supply and demand zone, right? There's a large difference between supply and demand zone. So the difference between the support and resistance and the supply and demand is basically the momentum of the market. A place where you saw a heavy bullish push. Please watch my video on supply and demand. Those are places that call supply and demand zones, supply demand. So that should be your next confluence you're looking at for, right? You should be looking at for your supply and your demand zone. Now you're still to order the confluences. And the next confluence you should also be looking out for. I didn't say you should look out for all at once, but at least 2 or 3 out of them should be in your setup before you buy or you sell. So you should be looking out for sorry, I've written this Fibonacci level. Yeah, also I want to type Fibonacci level. So these are the confluences you should be looking out for whenever you choose to take your trade. So the confluences. After knowing the trend of the market, the retracement, you should be looking out for Fibonacci retracement levels, right? You should look out for Fibonacci levels, right? So you take your trade at the Fibonacci levels. And which are the Fibonacci levels you should be looking out for? You should be looking out for Fibonacci levels from the 50% to the 100. That means you should be looking out for 0.5, 618, 786, 886, right? So these are the Fibonacci levels you should be looking out for, right? From 0.5 to 1, right? So you're looking at from 0.5 to 1. Those are the best levels to take your trade off. Don't be looking at 8.2 or those levels. You should be looking at to buy when the market is very cheap and to sell when the market is very expensive, right? So you should be looking at the Fibonacci levels from 0.5 to 1, from 0.5 down to 1, 0.618, 718, 786, and then 1. So now these are your confluences, and then the final the other confluences which you could look out for. You could look out for smart money play, right? Smart money or institutional play. So I wouldn't really be going much into that because that is not the idea behind this video. I'm just want to tell you how to smart money or institution. For those that trade smart money like me and my students, so look out for smart money or institution move. So, and now the final thing you should look out for is harmonics, right? The harmonic patterns. Harmonic patterns. So these are the confluences you could use for your trading. You can look out for these confluences. These are the confluences you should look out for placing a trade. I forgot to mention one, right? For this one, trade moving averages. So you could look, your moving average should also be in a confluence, the moving averages, right? So your moving averages, right? So your moving averages, the crosses, the divergence, and all of that. So the moving averages should be in confluence. And then the next one you should be looking out for is divergence, right? So if you have not heard, I did a teaching on divergence, right? So you could get it where you want it. So these are the confluences that you should look out for before taking any trade. You should at least have one, or let's say two or more of these confluences. That means whenever you're taking your trade based on the high time frame bias, you should see that area of your interest lining up with your order block, or your support and resistance, or your supply and demand zone, or your moving averages, or your divergence, or your Fibonacci level, or smart money, or your harmonic pattern, right? So this is how you line up all those confluences to give you profitable trades. So I just want to just show one example and then we call it a day, right? I don't want to make this video too long. I just want you to understand how to analyze your markets, how to analyze this thing, and be profitable in the long run. So now these are the confluences we are looking at for. We're looking at for order blocks. We're looking at for Fibonacci levels. We are looking at for all these things based on the higher time frame bias and all of that. So you can choose to use your 4 hours or structural higher time frame. You can choose to use daily, but I prefer you use the daily. Use the daily to check out what the market is doing, and then you can apply your trades according to the daily time frame. This will save you a lot of stress, right? Because the smaller time frame breaks structure too often, and these higher time frames are more stable, right? So let me copy this so that I can have it, right? So I've copied this. Let's look at let's go to let me look at, let's go to the forex in this. Let's look at euro. Okay, let's look at British pounds against the US dollars. British pounds, that is GBP USD. Let's use that to do some analysis, right? So this is GBP USD, right? This is GBP USD, right? So let's use this to check our confluences and what I just thought. So let's bring out our right. So let's bring out our confluences again. These are our confluences, right? So these are the confluences. Let's keep this here. So now let's look at this market. This market was bullish. We are seeing a series of higher highs and higher lows. So if you use our parabola line too, so from this point, you want to know what the daily is doing. So we saw a high, we saw a high again, right? It closed above this high. So we saw a low, we saw a high. You know, I don't like it actually dread everything. We saw a high, we saw a low, we saw a high, we saw a low. This was a bullish setup, and then we saw another high. Then there was a break of structure. So now look at the daily time frame. We can say the market was bullish all this way. Then now this is our structural point, our last higher our last higher low. So we can see that the market closed clearly below here, right? This is where the break of structure happened. Market closed below this last higher low. So we had our break of structure at that point. So we can highlight that. We can highlight that as our break of structure. This is the daily time frame. We want to know what the market is actually doing on the daily time frame, right? So we come here, we simply put BOS, break of structure, at this point here. So this is, we want to know what the market is doing, so you can trade in line with structure. So we have our BOS here. So, you know, after the market forms a break of structure, it has to retrace to give us our low high. So we can simply draw our Fibonacci level from here down to the zero. So the market started retracing from here, and as you can see what happened, let's bring our Confluence closer. Look at it. Look at what happened there. So this is the daily time frame. The market broke structure on the daily time frame, and then I told you that you're looking for Fibonacci levels from the 0.5 to 1. I'm looking for retracement from this point up to this point. You're not looking at for 38.2 or 28.6. So you saw the market came and it retraced where to your 0.5. Right, that was the first confluence. And look at this. Look at this. Let's zoom in. Let us zoom in. Now, we can see that this was the daily time frame. We saw that it bought for 3 days, and then look at this last bullish candle. Remember other blocks. This is another confluence at that 0.5 region. So if we draw our box from here, can you see that this was an order block? This last bullish candle, which coincided with this. Okay, let me draw this well. Let me draw this one. This was the week, and this is the week. So let me draw this a bit down. This is the week. Okay. So it came close to our 61.8, right? We're using the weeks, you know. Yeah, that drop body to body or week to week. So let me just try to see body to body. So if I'm drawing body to body, let me see where it will give us. Okay, 0.5. So let's just use body to body. So let me use week to week. You know, anyhow I want to draw it, but just make sure the measurement are the same, either week to week or body to body. So let me use week to week. So now we saw that the Fibonacci, the trade came into our Fibonacci level, which was our 0.5 area between 0.5 and 61.8. It doesn't really matter. It must not really be so perfect, right? But now we saw another confluence. Look at this. We saw our daily order block. And why is this an order block? Because this was the last bullish candle before this long sell that lasted for days. This sell lasted for days. Let's measure how many days this sell lasted. We want to know how it's lasted. So this is our date range. So from here to this point, you can see the sell lasted for okay, the sell ended there. So the sell lasted for 28 days. So this sell lasted for 28 days. That means this buy candle was able to push price for 28 days. We kept seeing the market fall down until it started retracing back up. So we saw this, and now we have our confluence, right? We saw our order block, which coincided with that point. And now I want to see if there was a divergence, right? Let's see if there was a divergence, right? So this was an order block, or you can call it a supply, a supply zone, because it is a zone where we saw heavy push from sellers. And if you extend this was some kind of what? This was some kind of resistance. Can you see this? Can you see how we're lining up our confluence? Look at the markets came here, sold, came here, sold. So this was a good place to sell from, because this was an order block, this was a resistance, this was a supply zone, and it coincided with our Fibonacci level. So when the market got here, we're not looking at sell. So what do you do at this point? You go to your smaller time frame and wait for that break of structure on the smaller time frame. Let's go to our 2 hour to see if we saw a break of structure on the 2 hour to give us entry. I told you that you must trade in line with structure. Don't just trade anyhow. Wait for break of structure. Wait for our accumulation, redistribution, and all of that. So let us check our 2-hour time frame. We can see something that will give us that telltale signal. Okay, guys, this market is going to sell, right? So let's go to our 2-hour time frame. All right. Let me go to 2 hour, because 1 hour will actually be so lengthy. Let's use 2 hour. You know, the bigger time frame, the fewer the candles, and it's easier it is for you to scroll through. Right. So I want to go to the level. Right. So now look at this. Look at this. Let's zoom in to this point. So look at our 2 hour time frame. Look at this. Look at this. Let's zoom in. Let's zoom in. We want to see how sweet this move was. So if we zoom in, this is our 2 hour time frame. Right. So this is our 2 hour time frame. Right. So looking at our 2 hour time frame. Okay. Look at our 2 hour time frame. Right. So we can see that the market came to this point. Right. Some people would have looked at this and said, okay, the market's made a high, made a low, and it's made a fail. Some people call it a failure swing. The market could not form a new high. Some people would have sold them because they saw the market failing to create a new high. So the market kind of gave that shift in market structure, that is a failure swing, and then the market came into this zone. Now look at how, look at the 2 hour time frame again. Look at this. After the market did this and gave this candle, let me zoom in so you can see clearly. Let me zoom in more. Look at this. Look at this. The market tried to break through that level, which was our point of interest. He gave this, he could not, and then it fell all the way down. It fell how many pips? 75. Okay, it fell over 70 pips, and now the market could not break it. Now this point would have been your point of interest. So if I remove this, so we can see that clearly. If I remove this, so we can see that the markets form some kind of supply zone. Look at this heavy sell. It lasted for 2, 4, 6, about 8 hours. Then the market retraces back into that zone. So remember our concept of order blocks and all of that. So if you highlighted this last bullish candle, right, to the future, right, you should be highlighting from the week. You should be highlighting the whole candle from the week down. So if you highlighted the whole candle from the week down, you have seen, you have gotten your sniper entry. If it just sold at the lower week, you know, you have to highlight the whole move. Or if you prefer, you can highlight from here to here and then play the 50%. But for entry purposes, it's better you just highlight from the week where you saw the market push up. So if you highlighted that whole move and played the lower week, you would have had your sniper entry. Now, if you want to use break or structure to make your entry, now we can see the market made a high, a low, a high. This was a failure swing, but this was the obvious higher low, right? So this was the obvious higher low. So if you want to play market structure, break or structure, so this would have been a break or structure here when the market closed below this point. So still we have seen a break or structure. Now waiting for the market to give us what our retracement to form a new lower high. So using a break or structure approach, all right. So we have seen that. So look at what happened again. Look at what happened. The market broke structure here, fell all the way down. This market was bearish after a broke structure here. So the market retraced down. So you would have drawn your Fibonacci level. Now you have known the bigger time frame point of interest. So you saw your break or structure. So you are not looking for a sell opportunity. So you draw your Fibonacci level from here to here. So right. So you draw a Fibonacci level from here to this point. Since the market broke structure at this point, so you're not looking for the market to come anywhere between the 0.5 to the 1. So the market retraced all the way. It came up, kind of gave some kind of, this was a little sell. It rejected at the 0.5 level, right? Which was some kind of support, as you can see. If you look at this, this was how many pips did it for? This is 95. Fell, okay, fell about 40 pips or thereabouts, but that wasn't really good. But I don't think there was much confluence here. There wasn't any much confluence. It was just a support, and no, there wasn't really much confluence. It was just a Fibonacci level and a support. All right. So the market came up again, and then look what happened. The market came to a very sweet zone. Can you see the sweet zone? Look at this. 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 The market came to this sweet zone. You know, there were equal highs there, so the market swept our equal highs. Look at this. This was the last bullish candle before all this. So if it was me, I would have been targeting this area. Look at this area here. This was the market formed some kind of supply zone around there. As you can see, this is how to line up all these things. So you can see how the market formed a kind of supply zone here at the 71.8 level. I can see markets fell all the way from this point. So this would have been my point of interest for me. But then the market gave a kind of stop one. This was a false break. And after this false break, the market sold how many pips? It sold from 82 down. Wow. It fell over 100 pips from this point. So after this false break, right, I advise you to always wait for market to reject at the level you're looking at. Don't just enter because market just enter. Wait for the market to give some kind of rejection or a slower momentum and all of that. So the market fell all the way. It still came back to that zone again and did some kind of rejection. And then look at what happened there. It tapped the 71.8. Why? Because there was an imbalance there. So there was a kind of imbalance at this point. So it came to feel imbalance. I didn't add this to our Confluence. I'm supposed to add this. So there was some kind of imbalance at this point here. There was an imbalance here. So that's why the market rallied all the way to feel imbalanced. So I didn't talk about imbalance in this video. So this was an imbalance here. So the market feel this imbalance before people falling all the way down. So if I saw the market finding it difficult to reject from here, if I saw this first touch, second touch, third touch, I wouldn't have entered a sell here because the number of times a support or resistance is tested, the weaker it becomes. So the market, I wouldn't have sold it again after selling all the way from this point to here. So I would have waited to see what will happen. So if I saw this imbalance, I would have been waiting for the market to feel this imbalance before selling. So as the market feel the imbalance and close rejected, I would have sold here and placed my stop loss above this week. So this is how you line up those things. So I didn't add this, so I'm supposed to add it. I'm supposed to add it to our Confluences. I'm supposed to add it. So one of the Confluences you also add is your imbalance. So I'm sorry I cannot really talk much in details about all of them because of the time constraint of making this video, and some information are not really really so simple to grasp at the first time or without personal one-on-one explanation. So I'm supposed to add this to our Confluences. So imbalance is part of them. Imbalance. These are the things you should be looking out for when you want to take a trade. You should have 2, 3, 4, 5 reasons so that even if your trade hits your stop loss, you can say, okay, the market does did this thing. Market does this thing sometimes. So all right, so so this is what I'm looking for. So we have imbalance, right? Have our imbalance. So these are the tools it is you should be looking out for whenever a trade comes to your point of interest, right? So that is it. So all right, today is Sunday. I'll be doing a weekly analysis on my Telegram channel. Please do well to join it with the link in the description. And also, I have to also share this. Our mentorship program is still ongoing. All right, it's still ongoing. Our mentorship program is still ongoing, and it's running up till now. Our mentorship program is still ongoing. So I would like to just share it with you. I want to just show you 1 or 2 things so you will understand what we are all about. So I'm sharing my screen now, right? So this is my screen. I'm going to my channel, right? So if you go to Electron FX, so this is our mentorship program. So this is our signature channel. This is where we post analysis. Sorry, not here. Electron FX. So that's what we're looking at for. So if you're looking at this point, all right. So this is the point I'm looking at for. So look at this. This is our signal channel. As you can see, we have about 71 subscribers, and you can see we are posting analysis, good analysis. Look at how these trades are playing out perfectly. Look at this. Can you see all this? This is why you should join our Telegram community. And then this is our mentorship program. So we teach you how to trade forex from scratch. You don't know how to trade, even if you're proficient in trading, we teach you how to trade whatever it is, synthetic indices, crypto, whatever, NFTs and all of that. We teach you how to manage your money and the emotions, your psychology to be constantly profitable. We teach you how to make sniper entries, that is little trader entries in the market. Watch my video on sniper entries to understand more. And then this only goes for 25,000 naira only, which is approximately $50 in equivalent, about $50-55 in the US dollars, but in Nigerian naira it's 25,000 naira. So for this week, we're doing a promo. We are reducing we're taking out $10 from this, so the 20,000 naira. If registered between now to Wednesday, we'll give for only 20,000 naira between now to Wednesday. After Wednesday, it's going back to the normal price. So do well to register for our class. We'll teach you how to trade. We'll give you signals. We'll hold you by your hands and help you to trade. So that will be the end of the video. Have a profitable week. Have a beautiful week. And that's the end of it for now. Enjoy your trading.